And oil still surging, but falling back below the $100 barrel mark, while stocks are mixed and there's some choppy trading. For more on this and investment ideas, let's go to Garnet Anderson, Head of Portfolio Management at Tacita Capital. Thanks for coming in.
Thank you for having me.
Okay, let's talk about oil, which we've seen really move up on the weekend, still up today, not as much. Are you invested in oil? What are you doing with your oil investments right now?
Well, first of all, pretty well any Canadian probably already is invested in. It's about 17% of the TSX composite benchmark. So you already have that. In terms of going into futures or what have you, or specific futures exposures, no. We have it through some of our models in terms of energy start to percolate up into the momentum sleeve, going back a month to 2 months ago, which we start to add in at that point as we start to shade away a little bit from the gold trade.
Okay, I was going to say gold is off, and we think of it as a safe place to go in times of conflict. So what's going on there?
Well, gold, so what happens when you have interest rates that have crept up, call that 20 basis points for, mid-belly Canadian and U.S., that means the cost of carrying gold is that much lower because it doesn't pay you any interest or any dividends. Then there was a little bit of strength in the U.S. dollar. So that also steals some of the attention away from gold. And the other thing too, it had been rolling ahead largely on central bank buying, on ETF buying, on jewelry usage. Central banks still are putting their pennies to work there and still accumulating. Naturally, the ETF flows are a little bit in and out. So it's not surprising they came for a breather, but there's a little bit of a boomerang effect. We're more a believer in bullion, necessarily as opposed to gold stocks. Plays a little bit of a longer-term hedge position against inflation. Short-term, it doesn't do much of anything. And what we saw was basically the gold price moved up in 23, 24, and then pulled gold stocks higher. Yep. And so we see gold up 75% last year, but gold stocks up 125%. And kind of makes sense because you go, oh, prices up, prices up, prices up. That means more cash is falling to the bottom line. Well, a little bit of reversal, but we're still up on the year. So I don't think it's time for anybody to panic, but it maybe is a little bit of a call to action in terms of those folks that have gotten a little loose and fancy free in terms of their allocations. Check their shoulder. It might be a time for rebalance. It's hard to sell into a rising market or a rising theme all the time. But if you can get some of your costs back out, it gives you a little bit more patience to ride it out.
What is your take, or how are you advising investors? We saw the big drops last week, TSX taking the hit. It's climbed back a little bit today, so it might end the day up. But are investors, you find, panicking? Are they selling in a panicked way?
No. If the TSX this morning was off 6% drawdown basis, you could start to say for more aggressive investors at the minus 5%, you might perk up your ears. You might look for certain opportunities. I mean, there's opportunities out there for the believers. I mean, you spoke about Constellation, or you got your other software providers, OpenText and what have you. And you certainly have in terms of the asset managers on both sides of the border, like the alternative asset managers such as BAM. So there's opportunities out there. But would not call it minus 5 or minus 6% a chance for the average investor to say, oh, this is buy the dip, I've got to push all my cash in. We came into all this revving higher on our cash allocations. And so for the more aggressive, we might be taking a look at nibbling. But for our average client, we're saying, look, that was there for buying protection. So that if we've got a marked setback for all the other things going on in the world, Kuzma, US, the US tariffs, the geopolitical, it goes on and on and on as long as your arm is. We want to keep some buffer there.
Okay. You like Suncor right now, and I know it was up like 60% last year. So would you still buy in? How long have you been holding?
We've been holding that now for, I'm going to say that one for about 4 or 5 months now. Okay. And so it is very good from an operation perspective. It's mostly sold to the Canadian marketplace. It's integrated. It goes from, extraction to upgraders to refineries to your local Petrocan. Okay. Some exports to the States, minimal international. It's got a good balance sheet. The thing that analysts like it, but it's close to its 12-month target. But what could change there? First of all, last year, the period ending in February, early March, it bought back like 54 million shares, 4% of its float. Okay. It just announced that it could buy back up to 10% of its float. Okay. That is a big buyback. Now, whether it gets to 10%, I don't know. But for every dollar, per their investor release presentation, for every dollar that West Texas goes up, it's another $200 million of profits. So if you've got $3.3 billion worth of shares to buy back, that certainly helps. That decreases your denominator, increases your earnings per share. So we think it's both good operationally, it's got good momentum, and we'd like to see that share buyback and discipline with the cash.
So you'd put new money in today?
Oh, that's an awesome question. We would probably, I guess we are comfortable with our current position. I think somebody who doesn't have, again, I think that'd be the remote investor in Canada who doesn't have energy exposure. I think it's a good candidate to go and put your anchor in. But these kind of trades in the midst of a panic such as this, don't put your full allocation. Edge in.
Okay. Let's talk about Chartwell REIT because you like this one as well. How long have you been in that space?
Well, that one we started to build back in 2020. Came out of COVID. And their vacancies, my recollection was down in the mid 80%. They naturally had all the cost of COVID, the extra nursing, the extra care, the plexiglass, you name it.
All the equipment, yes.
And so we said, well, this is a recovery play. We know demographics. That's easy part of the thesis.
Yep.
And they have executed very well. And so they've seen, like for example, you take the last year, their earnings per, or the revenue per same suite sort of thing was up 8-9%. And their earnings was up, 14%, 17%, somewhere around that area. So what's that showing is they've got operating leverage, which is nice. The other thing too is their share price has come so far back. I mean, we want to go from COVID, it's quadrupled. Now, mind you, it took about a 40% step back in 2022. When inflation interest rates take off, few are left unchallenged. And it's tripled since then. What does that do? It gives it a currency. They can now go out and acquire new residents. They can now afford to go out and build new capacity. So that should stoke future growth. And growth in the REIT market isn't always a given. They seem to have right now the good chemicals right there to be able to push that agenda forward. Brings different risks, development risk, acquisition risk, but we're comfortable with that. But again, because it has been so well, and there's other healthcare REITs as well, it would be one that would be a cornerstone of the portfolio, but it's not something that you would want to over-allocate to.
So
like
percentage-wise, where would you be with that?
Well, I would say that depends on how you slice and dice it. We would look at it as part of an over pool that's got 60-odd holdings. Okay. And in there, it's called 2.5%, 3% weight in there. Okay. Because again, it has done well, and the growth is there. Where in other areas like residential, office, retail's had okay growth, but you're always worried about the consumer, the non-defensive retail REITs. So the other areas in the REIT market haven't had the growth. The other areas in the real assets, kind of, we talk about energy. Yes. What about Enbridge? What about TransCanada? Great stocks. Yeah. Nice yield. But they are priced as such. So they're hard to put a lot of new capital toward.
Okay. Got to leave it there, Garnet. Thanks for coming in.
Thank you very much.
Garnet Anderson is head of portfolio management, Tacita Capital.